Hello and welcome to today's edition of the Savvy Money Show. If you like any of the entertainment you find in this video, please hit the like button. If you want to see more videos, please hit the subscribe button or make a suggestion in the comments below. If you're looking for a free trading platform on which to buy any stocks or shares, please check out the free trading platforms below. I use each one of them and they are all pretty good. I have done a comparison video in the past if you want to check that out. Now, here we go. Sorry about shaking, my son's the producer. Now, today we're talking about ETFs. There's been a stress testing going on for ETFs. They have been worried because of what's going on. A lot of them haven't had enough money to pay a dividend, and when they've been promising dividends. So what they've done is they've stress tested ETFs, because one of them, an ETF, is actually wrapping up this month, but we're not talking about that one. They are testing to see how long an ETF can pay a dividend for if the companies don't provide dividends, because ETF is different from REITs in that it can hold money, can keep money within the trust. Now, whereas a REIT has to pay 90% of its income to investors. Now, my opinion, and it is just my opinion, is that this one came out at the top. It meant it had more cash and it could pay a dividend for longer. It was more secure. The Lord Debenture Corporation. There was other ones like the Edinburgh and Schroeder, and you had JP Morgan, but this one at best has net asset value of 553 per share, and at fair value was 517 per share. And if you go down there, I'll try and put all this in a link down below. And this is the list of companies. It has Glaxo, Ceres, Royal Dutch Shell, Rio Tinto, Rolex, National Grid, Severn Trent, Herald Investment Trust, Flutter, AstraZeneca, HSBC, Prudential, BP, Dunelm, Land Securities, BAE, Urban Logistics REIT, Direct Line, Smith, Johnson Services, Morgan, Toyota, Croda, Cummins, Hill & Smith, Hypnosis, BHP, Smith & Nephew, Standard Chart, Balfour Beatty, Chesnara, St Malden, Mondi, M&G, Caterpillar, Rolls-Royce, Watkin Jones, Aviva, Hiscox, Axis, Lloyds, Marshalls, Spectris Senior, Scottish Oriental, BAT, Gibson Energy, Babcock, ITM, RSA, Royal Mail, IP Group, Bristol Myers Squibb, Irish Continental, Taylor Wimpey, Pfizer, Applied Materials, and the list goes on and on. Now I just think, although some of them are paying a dividend, some of them, like Royal Mail, are cutting the dividend, and they still have enough money in the trust. If all of them cut their dividend, and we know not all of them are, that they can carry on paying their dividend to the investors. And remember what I said their fair value was. it said that it was 553, sorry, 553 for the net asset value, 553, and 517 fair value net asset value. Now it's trading at 487. Now again, Yahoo Finance, they need to sort this out. It isn't showing a dividend and yield. But if we go to what is it? Yeah, we will see it's got a dividend yield of 5.4% and a PE ratio of 4.37. Yeah, great PE ratio, great dividend yield. Now, I'll put down their lowest price they've ever been as a price alert, just to keep them in there. When it opens, I will be buying some, just to secure the dividend. Now, I have other ETFs, and I have them because they are a lower management fee. But the problem we have nowadays is the dividend and securing the dividend. Once an ETF which has similar companies in starts announcing they're not going to pay the dividend, or once I break even on that ETF, I will shift the money into there. I may pay a little bit more management fee just for the guarantee of the dividend, as long as I'm not losing on the ETF, the price I paid for the ETF. Now, you have to decide what you want. Do you want guaranteed dividend and insurance on it? I mean, or do you want to pay an extra 0.5 or 0.1 and pay 0.5 or 0.1%? I'm not sure exactly. I haven't looked into that yet, but I will do before buying it. When I say I'm buying it, that means I'm looking into buying it. I need to check the management fee as well. But or would you rather be paying the management fee and not a lower management fee and not get end up having a dividend cut, which will bring down the price of the ETF, and then you won't be able to sell because you'll be losing too much money? That's a decision you have to ask yourself. Anyway, that's all from me. As I said, please hit the like and subscribe button. Right, see the return on assets 15%, 5-year average 7.5%, return on equity, return on investment. Yeah. Book value per share is above what a share costs. You know, it's quite impressive. Until they did this stress test, I hadn't even looked at this company. I'm glad I have now, because I've always been Vanguard or iShares, you know, because of their low management fees and their good diversification. Problem with Vanguard is they're based in Ireland, so for tax reasons. So if something happens to Vanguard, I doubt it will. It can be a bit tricky getting the money back, even though they are FCA registered. I'm not saying you won't get the money back. It can just take a bit of time. Anyway, have a good have a good day. Stay safe, stay investing, stay savvy.